The Bank of Canada has just made its trend-setting rate decision, deciding to hold rates at 5% for the second consecutive meeting, not changing interest rates. The Bank of Canada holding their rate at 5%, which is the highest level that we have seen in this country since 2001. Now, coming into the decision, this was widely expected, that the bank was unlikely to change interest rates in either direction. And this is for a couple of reasons. One, the most recent print on inflation showed that things had started to cool down. The Bank of Canada's own Business Outlook survey suggested that businesses were getting nervous about things like demand. Data points from the housing market suggesting that things are starting to slow down. And when you look at things like retail sales volumes, even though it's backward looking, it was suggesting that there was a bit of a slowdown when it came to the consumer. You're seeing the Canadian dollar pull back. Now, on the back of this, we are also going to be getting the Bank of Canada's monetary policy report, in which they update their projections for inflation as well as economic growth. For 2023, they expect 1.2% economic growth. This is a deceleration from the July MPR, where they saw about 1.8% growth. So it looks like they're revising their growth forecast lower. And as I look for their inflation outlook, they are calling for inflation to average 3.5% through to 2024 before reaching 2% in 2025. It looks like they are then pushing out when they expect to hit their inflation target, meaning it's going to take longer, which is another way of maybe hinting at a higher for longer interest rate environment. The Bank of Canada explicitly saying that inflationary risks have increased and progress to target. Remember, their target at 2% is slow. So it's a hold, but we'd probably call this in the business a hawkish hold, that is signaling that they are more inclined to raise rates or keep monetary policy tight because inflation is still quite stubborn. So that's what we know right now. Let's put some context around it. We've got Jim Thorne, he's Chief Market Strategist at Wellington Altus Private Wealth, and Earl Davis, Head of Fixed Income and Money Markets at BMO Capital Markets. I'll start with you, Earl. Consensus was expecting basically what we got, but when you look at how they're toggling projections, it's hard to ignore the fact that they're warning we are far from in the clear here.
I agree, and we believe it's now their base case that they will not hike, but they want to remain hawkish so the market doesn't rally. Remember, when they paused in January, they removed their hawkish bias, and that's when you got a lot more purchasing of houses as well as other things, and they want to prevent that this time along.